Hey traders, listen to this.
Stick to one very simple rule to improve your results immediately. Only buy when you are below the opening price and only sell when you are above the opening price. If you find a really good buying opportunity and you are not below opening price, do not take the trade. The trick is understanding how candles work. They open, and in a bullish environment they're likely to come lower first, preferably into some kind of point of interest area, and once price is rebalanced into that area, it is likely that price will respond and then push to the upside, which from a candle's point of view will leave behind a wick. Your job is to try and get in the market anywhere under opening price inside a higher time frame point of interest area. So in this example, price is bullish. We can see an order block which is also within our discount zone under opening price. So this opportunity here would have been the perfect trade opportunity, and you're basing that around the fact that you are under the candle's opening price for that day.
Wow! It seems easy and profitable. Traders, please allow me to explain some things. Here, we buy when price is below the opening price and sell above the opening price. I know this is where you all don't understand. Now listen. Opening and closing price, he refers to daily candlestick pattern, which is the daily time frame candlestick pattern. This represents one-day market movement. So, you mark the opening of the daily candlestick pattern on daily time frame. When he say this, we buy when price is below the opening price and sell above the opening price. In this case you look for reversals, because you can't just buy and sell anywhere. On this higher time frame, look for point of interest where price tend to react to. Here, he pays attention on candlestick formation on the point of interest, whereby it's expected price to get rejected on the point of interest, forming a wick. Do you know what a wick is in forex trading, its role? Let's briefly do a candlestick wick analysis. The term candlestick wick analysis refers to analyzing wicks on candlesticks, which are used to gauge trends in the financial markets by comparing them to previous candlesticks. The wick refers to the part of the candlestick that hangs down below the body, which represents both its high and low points over a specific period. By focusing on these parts of candlesticks, you can gauge trends in financial markets, especially when candlesticks form patterns based on wicks. The wick is a thin vertical line on either side of a candle's body. While some people may refer to the wicks of a candle, they are technically only referring to one. It is so named because it resembles an actual candle wick. The terms wick bottom and wick top refer to whether a candle closed at its highest or lowest point to its prior candles. If a candle closes higher than its opening price, then it has a wicked top. If a closing price is lower than its opening price, then it has a wick bottom. A normal candle without any disturbances in its movement is said to have no wick. This simply means that when one candlestick ends, another begins immediately after without interruption in price movement. When there is a break from price movement where there isn't a new candlestick formed, it is referred to as having a wick or tails, because sometimes tails can be long enough for light from previous candles to shine through. Though called wicks, they aren't always exactly straight. The shape of each wick, including curved ones, interprets different things about market sentiment over time. Singularly, wicks provide limited information about market direction. However, by comparing the size of several wicks with those preceding them and those following them, we can develop a better idea of the sort of longer-term trend that may exist. For example, if there are 3 small daily wicks followed by a large fourth one, then it signifies that the sellers were stepping into sell orders throughout most of last week but started to become exhausted Friday night into Saturday morning. This indicates that the bulls saw an opportunity to step in and push prices higher. Conversely, if we see 4 similar-sized wicks followed by a much larger 5th one downward, then it tells us bears had more ammunition left in the late Sunday afternoon into Monday morning. These are just 2 examples of how looking at multiple wicks can give us insight into how bearish or bullish overall sentiment was during certain periods within larger trends. By themselves, however, wicks don't paint very complete pictures of overall market sentiment. You need to look beyond just one day to get an accurate assessment. Advantages of candlestick wick analysis. 1. Separate price movements. The candlestick wicks separate price movements, so you can see what is happening at each level of supply and demand. This helps reveal trends earlier than using other forms of analysis alone. 2. Shows market sentiment. The color of a candlestick provides insight into market sentiment because it shows how long buyers or sellers were in control of price during that period. 3. Helps confirm trends. Candlesticks are often used with technical indicators to confirm trend direction. 4. Trend direction confirmation. A candlestick pattern showing 2 or more white candles followed by one black candle indicates that a downtrend has reversed to an uptrend. An example would be white candles on top of one another, separated by thin lines. 5. Identify reversal points. Since a black candle means a seller won out over a buyer for most or all of that time, observing where it appears within your candlestick chart allows you to identify potential reversal points. 6. Identify support and resistance areas. In addition to reversal points, support and resistance levels can also be identified from where different colored candles appear on your chart. Importance of candlestick wick analysis. The candlestick chart is one of many chart types used by investors to analyze market behavior. At first glance, candlesticks may seem simple, but they represent quite a bit of information about market activity. When more experienced traders look at them, they often see patterns, and that's where candlestick wicks come in. A wick represents an upward or downward tail that sticks out past an individual candle body. These tails can be extraordinarily helpful in identifying trends and spotting common patterns among different instruments. The wicks represent price action, and their relative lengths indicate if current prices are trending up or down compared to previous periods. Specifically, shorter wicks indicate a period of lower prices than previously seen, and longer wicks mean higher prices than before. It's important to note, however, that candlestick wicks do not have a uniform length. Instead, they vary from as little as 1 day to as much as several months. In addition, many analysts argue you should ignore wicks altogether when trading since they have no predictive value for future stock performance. So, what you will be doing is to make sure you take trades anywhere under the opening price inside a higher time frame point of interest. In a bullish example, price is bullish, we saw our order block on a discount zone under opening price. Using a discount zone is whereby you use the Fibonacci retracement tool. Where on premium zone, you tend to sell, and on discount zone, you tend to buy. So, when you find this order block either on this zones, consider it as your entry reason. Let's break down some new terminologies. Area of interest in Forex trading. So, what are areas of interest in Forex? Areas of interest in Forex are specific price levels or zones that have shown historical significance in the market. These can be levels where the price has repeatedly reacted, causing either reversals, accelerations, or significant breaks in trend. Common areas of interest include support and resistance levels, order blocks, fair value gaps, trend lines, Fibonacci levels, and psychological price levels. Types of areas of interest. 1. Support and resistance levels. These are basic yet powerful concepts in Forex trading. Support levels are where the price tends to find a floor and bounce back up, while resistance levels are where the price often hits a ceiling and falls back. 2. Trend lines. These are drawn by connecting rising lows in an uptrend or falling highs in a downtrend. Trend lines act as dynamic support or resistance levels. 3. Fibonacci retracement levels. Derived from the Fibonacci sequence, these levels are used to predict potential reversal points in the markets. 4. Psychological price levels. Round numbers like 1.3000 in euro to US dollar or 1.0000 in Australian dollar to US dollar are considered psychological levels and often see a clustering of orders. Importance of identifying areas of interest. 1. Entry and exit points. These areas can provide strategic entry and exit points for trades. Traders often look for price action signals at these levels to make informed trading decisions. 2. Risk management. by understanding where the market may potentially turn, traders can set more effective stop loss and take profit orders. 3. Market sentiment analysis. Areas of interest can indicate prevailing market sentiments, helping traders gauge whether a bullish or bearish trend is likely to continue or reverse. How to identify areas of interest. Technical analysis. Use technical tools like chart patterns, indicators, and price action to identify significant levels. Historical price levels. Look at historical data to find levels where the price has shown significant reactions in the past. Volume analysis. High trading volumes at certain price points can also indicate areas of interest. Strategies for trading areas of interest. 1. Price action trading. Watch for candlestick patterns like pin bars, engulfing candles, or dojis at these key levels for potential trade setups. 2. Breakout trading. A breakout through a key area of interest can signal a strong move in the direction of the break. Traders may enter a trade post-breakout or wait for a retest of the level. 3. Confluence trading. Combine multiple areas of interest, like a Fibonacci retracement level coinciding with a psychological level, for stronger trade signals. Challenges and considerations. False breakouts. Not every interaction with an area of interest will result in a predictable outcome. False breakouts are common and need to be accounted for. Changing market dynamics. Areas of interest are not static and can change with evolving market dynamics. Continuous analysis is necessary. Conclusion. Areas of interest in Forex trading are invaluable tools for traders seeking to understand and anticipate market movements. Identifying and effectively utilizing these areas can lead to informed decision-making and potentially profitable trading opportunities. However, it's essential to remember that Forex trading involves significant risks, and strategies involving areas of interest should be part of a well-rounded trading plan that includes robust risk management techniques. As always, traders should remain adaptable and continuously educate themselves to stay attuned to the ever-changing Forex market. It's important to know about areas of interest because they play a very vital role in Forex trading. This brings us to the end of this video. Don't forget to subscribe, like and share. I will see you in my next video. Listen traders, before you make any big mistake, like paying for that expensive course, try reading this book first. This is basically what you are going to be taught by your mentor. In fact, not even everything. If you are a beginner and you have learnt only basics, don't dare funding your Forex account because you will not like the results. This book will introduce you to another side of Forex trading because you cannot like forever buy at support and sell at resistance. This book comprises of everything you need to know about smart money concepts and price action, and everything is explained simply. Grab your copy at $10 only and it will save you from a lot rather than paying for
Now,
those so-called
if you want to kick off your
Forex journey, WhatsApp this number to order your copy. First come, first serve.